Hello, and welcome to this fireside chat, Global Trends and Landscape of Decentralized Finance. I'm Joanna Ossinger, Global Markets Editor and Asia Crypto Czar at Bloomberg News. And I am very pleased to have with me Ben Forman of Verify Capital. Thanks for joining us, Ben. Can you just start us off with an introduction to Verify Capital and what your investment thesis is?
Yeah, thanks, Joanna. So Verify is an investment firm that's focused exclusively on the DeFi ecosystem. So we are investors, power users, and governance participants really across the DeFi stack. We've been investing in the space for 4 years. So we've followed and backed many of these projects at very early stages when DeFi wasn't even a term, and have kind of continued to invest as the space has evolved over time. In terms of kind of how we're set up, we invest directly in tokens and our participants in DAOs in both private and liquid markets. We also have pools of capital that actually use the protocols. So we think the best way to understand DeFi is to use it, and so we have pools of capital that are large traders on DeFi applications, are borrowers and lenders from different DeFi applications, and kind of understand them from a user's perspective. And then in addition to that, we also are large investors in companies in the space, companies that don't have tokens but provide some critical infrastructure. So that's kind of just to give you a sense of what Verify looks like.
Okay, great. Thank you. So which segments of DeFi are particularly exciting to you right now?
Yeah, so the way we kind of think about segmenting DeFi is really into 4 different categories: fixed income, asset management, insurance, and trading. So decentralized derivatives or decentralized exchanges. Those are really kind of the 4 primary categories. And if you kind of drill into most DeFi apps, they'll fit into one or more than one of those buckets. From my standpoint, the most interesting has always been fixed income. It's like the ability to access credit and the ability to earn yield are enormous markets that tend to be very inefficient in traditional capital markets. Before getting into crypto, I worked in credit and investing in different fixed income products, and the amount of back office requirements to reconcile, accrued interest, to settle trades, is really like mind blowing, and it's actually gotten worse over time. It hasn't gotten better, and these different DeFi applications that enable credit tend to be not 10% better or 10x better. They're almost 100x better than the process of getting credit or lending in traditional markets. So you look at kind of Compound, Aave, MakerDAO. These are marketplaces where lenders can earn a higher return and borrowers can pay a lower return, and there's just this consumer surplus that's effectively unlocked. So yeah, for me, credit is really kind of one of the most exciting categories. I think just broadly, like thematically, the thing I'm most excited about is for this idea of abstraction to really take hold in DeFi. So this idea of people using DeFi and not knowing they're using DeFi because it's all invisible, it's all on the back end. So you're seeing kind of an emergence of neobanks, fintech companies, and traditional financial firms that are effectively, offering a front end to their clients, and then on the back end, they're using DeFi to earn a higher yield. And that I think is going to be just an unleashing moment for the space. In some future state of the world, I think DeFi will be just called finance. They'll be indistinguishable. Right now, there have been roughly 3 million wallets that have ever touched DeFi or have ever interacted with the DeFi protocol. And it's mostly people that are highly technical, people that understand gas prices, people that are able to store their own private seed, people that are able to initialize a ledger. But how many people in the world are there that can do all of those things or want to take the time to do all those things? It's not too many. So I think that in order for all these different DeFi services to scale to hundreds of millions or billions of people, you're ultimately going to need an aggregation layer. So things like compound treasury that just make all the complexity invisible to the end user. And you're really starting to see that, which I think is incredibly encouraging.
What do you think is the time frame for that? Like, are we going to be seeing this in 2 years, 5 years?
Yeah, so there is a little bit of a time warp in crypto where things move and scale incredibly quickly. I like to say kind of crypto moves in dog years in terms of the compression of activity into short periods of time. At the beginning of this year, there were roughly kind of $20 billion worth of stable coins. Today there are over 100 billion. So we've already gone up 5x year to date. And in 2020 we went up kind of 20x over the course of that year. So things are moving kind of exponentially, and they're really accelerating. And what's interesting, like if you look at other technologies like the internet, is they required physical infrastructure in order to scale. So you had to lay fiber, people had to buy mobile phones, and those, to get to 80% internet penetration, it took several decades. What's interesting about DeFi is these technologies are built on top of the internet. Everything in the blockchain space would not be possible had it not been, if the internet didn't exist. And so fundamentally, everyone has a mobile phone today, or the majority of the world has a mobile phone, the majority of the world has internet access. And getting from that point to interacting with DeFi is actually quite easy. So I think scaling can actually happen, could happen very quickly. And a lot of the pieces are coming into place. The usability of the applications, the scalability, the gas prices, scalability, transactions per second, activity you're seeing on other layer 1 blockchains, L2s, is incredibly encouraging. Perhaps like the biggest risk is kind of bad regulation, like regulatory overhang or uncertainty that basically restricts institutions from interacting with these protocols, or deters talented founders from building these protocols. But I think otherwise the pieces are really falling into place, and I think DeFi in 2 years ultimately is going to look like radically different than it does today.
Okay, and just picking up on the regulatory aspect. So what can investors and companies in DeFi do to work with or educate regulators to see what to make intelligent regulations?
Yeah, so I think education is critical, and I mean the reality is new technologies move faster than regulation in almost every. I think that founders and teams in the space ultimately, I think making sure consumers are protected is really important. So if you're launching a DeFi application, making sure you have the appropriate disclaimers on your front end, making sure that your smart contracts are properly audited and have been tested robustly prior to making them public. And then the second thing is really making sure that like securities laws are abided by in good faith. And I think those are like two fundamental things. In our conversations with regulators, it's clear that they see the promise in this technology. And actually the Fed recently came out with an excellent report on DeFi talking about MakerDAO and Uniswap. And really, I thought it was incredibly thoughtful. And they referenced really the potential for this technology to bring financial services to more people, to make financial services more efficient. So I think regulators are really, for the most part of the conversations we've had, are really like leaning in and excited about the potential for this technology. But they're playing catch up because DeFi now has over $100 billion of value locked in smart contracts. And you go back a year ago, it was effectively $1 billion. So it's increased 100x in the past year, and it just isn't realistic for regulation to really keep pace. So, there's a lot of work to do. And candidly, we talk to a lot of institutional investors at Verify, and oftentimes their biggest concern in investing in the space is lack of regulatory clarity. And I typically say, look, we're not going to have regulatory clarity for probably 10 years. I mean, there are 200 countries in the world. Within each country, there are multiple agencies responsible for regulating something like crypto. I mean, in the US, you have the SEC, the CFTC, there's FinCEN, there's the IRS. It's not just one group and it's not just one country, and there's a lot of catch up to do. So that doesn't, to me, once there is regulatory clarity, crypto will already be a much bigger asset class. But I think it's going to take a lot of work on the part of the entire industry to really work with regulators on making sure that the technology is embraced.
Okay, so is that the main thing that needs to happen for institutional DeFi to be successful, or what other factors are big in that?
I think there are three things. It's regulatory, it's scalability, and it's usability. I think those are the three major factors that could be impediments to the adoption of this technology. So on the scalability side, there's a lot of progress being made. You're seeing DeFi move beyond just Ethereum to other blockchains. A year ago, over 99% of all smart contract activity was taking place on top of Ethereum. Today, it's closer to 75 to 80%. So you have other blockchains like Solana, like Binance Smart Chain that are seeing DeFi applications launch. These other layer one blockchains typically offer more scalability and less security than Ethereum. So there are trade-offs. And so we're moving, but I think it's positive that we're evolving beyond just Ethereum. And then in addition to that, there are other layer two environments similar to Arbitrum, who spoke right before me, where these are effectively side chains or chains that run in parallel to Ethereum's main chain, which is really becoming more of a settlement layer. So scalability is a big, you can't run global finance on blockchains that scale at 7 transactions per second. But because of all the bridges, because of all the layer twos and other layer one blockchains, the scalability challenges are really starting to be solved, which I think is quite encouraging. And then on the usability side, I mean, we covered this earlier. DeFi has to be as invisible and as unnoticeable as possible for it to be usable, because it's similar to sending an email today. When I send an email, I don't think about using SMTP. I just open up Gmail or Outlook and send an email, right? And that's really like, you don't want any more complexity than something that just works. So from a usability standpoint, I think that there was this vision of each of these DeFi applications effectively hosting a front end that was a web browser that people can show up at, connect their wallet to, and start interacting with these applications. But I think it's becoming very clear that these applications are really evolving into more back ends or really kind of the API layers, and other businesses are going to be built on top of them over time that really own the user experience and make things easier.
Okay, so do you think that's the main thing that needs to happen for DeFi to be increasingly accepted in the broader world, or are there other factors as well?
No, I think those are really those are really the three. I think that yeah, I think that those are really the primary three factors. I think there are other kind of more minor components. For example, we talk to a lot of institutions that want to access the higher yields offered on on stable coins, on these different DeFi applications. But it's actually it's not as easy as just kind of making an investment and sending a wire to a company. You need to be able to store private keys. You need to have controls around who can move coins on chain and what that process looks like. And that can be very complex. And so I think I think infrastructure is probably the fourth component. It's just amazing to me across all these different dimensions: regulatory, usability, scalability, infrastructure, how far we've come over the past year. It's a completely different experience. And so I'm quite optimistic that if you kind of extrapolate out the progress that's being made, these things really won't be limiting factors in the same way that they are today.
Okay. And so what do you think is the impact of funds like A16Z raising these mega rounds? So what does that mean for DeFi companies, and what does it mean for VCs?
Yeah, I mean, look, it's a good thing. It's incredibly. It's a great testament to just institutional interest in the space. I think I recently heard that A16Z's crypto funds have more AUM than their non-crypto funds, than their traditional venture funds. So it's really amazing to see. In terms of how it affects the underlying market dynamics, I think that you're seeing an environment where private round valuations for early stage DeFi projects have probably increased 10x year over year. So the same team with the same PowerPoint deck, having made the same amount of progress, pitching the market gets roughly a 10x higher valuation today than it did a year ago. I think that number is probably going to continue to trend up, just given how strong performing these historical vintages have been. I do think that there's a trend that I'm kind of acutely aware of, that I've been noticing in the venture space, which is specifically that people think and call token investing venture capital, but the amount of capital formation taking place in private markets for DeFi projects is actually somewhat limited relative to what's going on in liquid markets. So the amount of capital basically that a team needs to launch a DeFi application is incredibly low. You can have a team of 2 or 3 people launch a DeFi application with effectively no capital if they don't need to take a salary, or with enough capital to sustain the salary of 3 to 5 people. And then once you launch a token, you can implement liquidity mining. And if you're good enough at community building, good enough at getting users, you can kind of get on a flywheel where you'll never have to raise another round. So in traditional venture, it's seed, Series A, Series B, Series C, lots of dilution events, lots of capital intensity, businesses running at negative free cash flow until they hit scale. Whereas in DeFi, it's one round to launch it and then launching a token, and that round is typically very small. So an increasing amount of deals we're seeing are just directly on chain. So there are treasuries that are selling tokens to funds. There are funds that are accumulating positions in liquid markets. And it's really happening kind of outside of the construct of traditional venture. It still amazes me that you have protocols like Uniswap that's valued at $18 billion today, fully diluted, that raised $11 million of venture capital to build something at that scale, or something like or a protocol like Wi-Fi that never raised a single dollar of venture capital and is valued at a couple $2 billion. So it's pretty amazing just how little capital it takes to bootstrap these networks. And as a result, if you're going to deploy $2 billion in the space, you're inevitably going to need to do it through liquid markets, not just through private rounds. So that whole dynamic is really beginning to change.
Okay, that's interesting. So what do you see as kind of the biggest trends in terms of these deals, or what's kind of stood out to you as a development in it?
Yeah, I think on these deals, the new kind of type of a breed of deal that we're seeing is we call it a PIPE T, private investment in public token. It's almost like an analog to a PIPE in public equity land. And it effectively entails these protocols, these DeFi applications that hold their native token in their treasury. Sometimes they want diversification, sometimes they want to raise capital, and they want to sell their tokens, but they want to do it they tend to want to sell to institutional investors who are willing to agree to a lockup. And so you've seen this in a number of cases, which is a group of funds will team up to buy tokens directly from the treasury of different DeFi applications. And it's typically at a discount to market prices. And it's typically agreeing kind of to some sort of lockup period. So it's almost like a new form of venture capital, because the counterparty that funds are buying from they're not negotiating with the CEO of a company or getting approval from a board of directors. They're really buying from directly from a DAO, and the community needs to approve the deal. So it's just an interesting change in deal dynamics, and I think we're going to see more and more PIPE Ts going forward.
Interesting. Okay. And are you seeing anything specific that kind of affects the demand for deals or valuations, like price of Bitcoin, or does that not have an effect? And do you think it's good or bad that these things might have an effect?
Yeah, I think that the price of like different tokens in the market, like there actually tends to be, crypto, there's a lot of entropy, right? There are, close to 1,000 tokens that have over 10 million market cap. And if you want to expand the universe further than that, there are several thousand tokens. So there are roughly as many tokens as there are public equities in the US. So it's a very broad market, and there's a lot of entropy and a lot of information asymmetry. And despite the fact that people tend to think that crypto is highly correlated, there tends to be a fair amount of return dispersion within the space. So the difference between owning, the top quartile of performing names versus the bottom quartile is, can be the difference between being up 10x or down 50%. Whereas in traditional asset classes, the top quartile and bottom quartile tend to be very clustered and kind of be more range bound. And so in terms of factors, affecting the market price, market prices, we see, we see tokens kind of trade more idiosyncratically, and in an uncorrelated fashion, and sometimes in a fashion that doesn't really make much sense because the asset class is very immature. Something like Bitcoin really has nothing to do with Ethereum. Practically and those are just the two biggest tokens. They're completely different things, right? Bitcoin is decentralized money. Ethereum is a decentralized computing platform for developers. The one is more of a macro asset. The other is really more of a technology bet, right? And those are just the top two. Kind of when you parse through the entire universe of digital assets, it's a very heterogeneous group. So to your question, should the price of Bitcoin affect, other deals, the price of private deals in DeFi? Like probably not, because they have really nothing to do with each other. And over long periods of time, that tends to be the case. Over short periods of time, the market tends to be more correlated. And I think that's just a function of kind of like leverage and things like that.
Okay. So we just have a few minutes left, but if you can maybe just kind of sum up what you see as the most compelling things going forward in terms of trends for DeFi and what the potential is.
Yeah, so one really interesting just idea that's completely unexplored in crypto is this idea of capital structure. So if you think about like all these DeFi tokens, effectively what they are equity in DAOs. So if you own a DeFi token, you're entitled to the cash flow generated by DAOs, and your pro rata portion of it. But what is completely unexplored is this idea of debt, right? Protocols don't have debt. Companies have debt, but these DAOs don't have any debt. They just have all equity capital structures. So you can imagine a state of the world where you have an application like Uniswap that thinks its token is undervalued and wants to issue a bond that's senior to the equity in its capital structure and potentially use those proceeds to buy back its token. Or you can imagine a scenario where a company may want to borrow, or a protocol may want to borrow in order to keep cash in their treasury and fund developer grants to build new applications on top of their protocol. So this idea of credit just doesn't exist in DeFi at the protocol layer. The idea of protocols taking on debt, and I think that that's incredibly unexplored and could be just a whole new kind of financial primitive. Once you have tokenized debt of protocols, you can have securitization markets. That there'll be secondary trading markets for that debt, and it'll kind of unlock, I think, like another wave of interesting products.
Okay, that is all very interesting. And now I think we're out of time, but Ben, thank you so much for your time, and thanks to SCB for this conference, and thanks for joining us, everyone.